Welcome to today's podcast. Today we travel across to New Zealand, where Chaz Keogh and his team will cover off on the New Zealand market.
I'm Chaz Keogh, Senior Director, Office Services, New Zealand. You will shortly be hearing our views on the office leasing market in New Zealand's major cities, Auckland, Hamilton, Wellington and Christchurch. First up is Campbell Pritchard, Associate Director, Office Services, who will be covering off the Auckland office market. Campbell, the Auckland office market was the most robust of all New Zealand markets in 2010. Can you please provide us with an overview of where you see us today in mid-2011?
It was robust in 2010, and I think it's continued to show improvement this year. The Auckland economy has remained resilient after the Christchurch earthquake, and the downgrades to New Zealand's economy that came through immediately after the earthquake haven't had too much of an impact on Auckland. Net absorption remained positive for the first half of 2011. The positive absorption has largely been due to a few occupier shifts into new buildings. For example, Telecom, Westpac, Ernst & Young, Southern Cross. In all instances, they've taken up more space than they left behind. Other indicators of how strong the market is today include the leasing of 10,000 square metres of space in the recently named Zurich House at 21 Queen Street, 6,000 square metres at 2 Nelson Street to Goodman Fielder, 5,000 square metre pre-commit to a new build at 8 Mahuhu Crescent by engineering firm ACOM, and 4,000 square metres at 41 Shortland Street to Fonterra.
Where do you see the market progressing for 2011?
I think we'll see continued positive activity for the second half of the year. In addition to many substantial leasing transactions already confirmed, economic growth has been buoyant in most business sectors. I think businesses are in a growth phase. They are feeling more optimistic. They view the current leasing market as one where they can upgrade their office accommodation without the need for capital expense. Market sentiment has been further buoyed by ANZ National's recent commitment to stay put at the ANZ Centre. While any move by ANZ wouldn't have resulted in a major increase in vacancy until 2013, their commitment has already sent positive ripples for vacancy and landlords in the Auckland CBD.
Lastly, what advice would you give for our clients in the current environment?
I believe the best advice is to be proactive across your property portfolio. The market is turning and we expect to see steady activity and increasing effective rentals over the next 18 months. I recommend our clients plan for capital expenditure in their buildings in order to take full advantage of current inquiry.
I would now like to introduce you to Mike Neal, Director of Office Services in our Hamilton office. Mike, how would you characterise the leasing market in Hamilton in 2010?
In one word, soft, which has had positive flow-on benefits for tenants, with lower vacancy rates for better quality office accommodation. Landlords in many instances have been forced to undertake capital upgrades in order to attract or retain tenants, as was the case with Rico late last year. It has certainly been a tenants market with moves to better locations, more economic layouts and better quality accommodation, including amenities for both staff and clients.
The last quarter of 2010 and the first quarter of 2011 has seen some positive signs in the Hamilton leasing market. What do you see as the major changes from the preceding period last year?
Tenant inquiry has risen significantly, with a number of corporates and government entities looking in many instances to consolidate a number of tenancies, to create economies or secure a premium position. Several new builds are underway and we have recently been engaged to lease the first office tower to be built in Hamilton CBD since the 1980s. It's anchored by a new lease to PwC, who are taking 2 of the 4 floors, with construction scheduled to commence later this year. Tenants are making decisions and landlords have accepted the current market conditions, and in most instances this has created a transactional environment.
As a result of some significant aftershocks in Christchurch yesterday, Bryn Burrows, Head of Office Services in Christchurch, is unable to make it today to present to you on this podcast. Fortunately, he's been able to answer a number of questions on what has happened to the Christchurch office leasing market since the second earthquake, and where to for the future of the Christchurch leasing market. The second earthquake led to a complete shutdown of the CBD and consequently a mass exodus of office tenants to the fringe of the CBD and suburban locations, primarily in the western suburbs. The unprecedented surge in demand for suburban office space has led to high levels of competition which has naturally driven the rental rates up, reduced or removed incentives, and resulted in long-term commitments from major corporations and government tenants. Some example rental rates for suburban office space prior to the February earthquake typically range from $250 to $275 per square metre net, with the upper end achieved in Show Place at around $300 per square metre net. The new net rental rates being achieved in Hazeldean and Addington Business Park following the earthquake are circa $300 to $330 per square metre net, with secondary space such as Workstation 55 achieving approximately $250 to $275 per square metre net. Subsequently, there is now a significant shortage of supply to meet current demand, and it is difficult to predict how long this demand will continue. We believe there are two main factors influencing the future of the Christchurch CBD office market. One, how long the demolition and rebuild will take, and two, the significant timing implications as a result of new long-term lease commitments by major corporate and government tenants. The shape or form of the new look CBD will take a significant amount of time, and it is unclear at this stage what shape it will take. However, indications are that tenant demand is tending towards modern low-rise buildings. The general layout of the city is likely to remain largely unchanged due to the huge amount of capital currently invested in the infrastructure. An event such as the earthquake on February 22nd is devastating and changes lives forever. However, it also creates opportunities already seen in the booming suburban office market and will undoubtedly result in opportunities for CBD landlords. Moving down the country to our capital, Wellington, our next panellist is Matt Hintz, Director of Office Services. Matt, I'll hit you with a double question. With the Wellington market being the head of government and a ruling government focused on efficiencies and cost cutting, where do you see the future of office leasing in Wellington? And are office vacancies really expected to reach the high teens in terms of percentages?
Thanks, Chaz. Look, let's wrap some context around that. The Wellington CBD is approximately 1.4 million square metres. Of that, roughly 44% is occupied by the public sector, clearly a very important part of the town's business. Now, the current National Party regime is one of fiscal prudence. What that has meant has been very little positive net absorption for the last little while, and it's something we're likely to see going forward. Having said that, there have been winners and losers. A lot of organisations have moved from the fringes, smaller, poorly located buildings with bad services, into buildings closer to the hub of the action, particularly government. Buildings with larger floor plates, modern services capable of supporting higher occupancy rates have done extremely well. The detriment to, of course, those poorer located buildings. In fact, we've seen positive net absorption to the tune of 33,000 square metres over the last 6 months in the A and B quality of building, and a correspondingly negative amount of almost exactly the same in the C and D. So that brings us on a little bit to the second question. In a nutshell, yes, I do see the overall vacancy going to the high teens, or the potential of it to do so. And that might seem a little bit alarmist on face value, but the reality is a lot of that space, approximately half, may not be suitable for ongoing office accommodation and therefore withdrawn from stock. What those uses for that space is, we don't know yet, but they'll probably be withdrawn from those figures, keeping a cap on that overall vacancy.
Has it? And going forward, will the Christchurch earthquakes have a significant impact on the Wellington office market? And what can our clients do in order to see the least amount of impact from this situation?
Well, I think undoubtedly it is going to have, and already has had a significant impact. I mean, the reality is Wellington has always been the city in New Zealand that's been deemed most earthquake prone. So what we're doing at the very least is advising our clients to look into very stringent structural reports on the buildings to at least ascertain whether there is a risk issue there, or if there is, what can be done to mitigate that. The dust is certainly yet to settle, so the reality is we don't know what the full impact of the devastating events in Christchurch will be in Wellington.
Thanks for watching, and we'll see you again for the next New Zealand podcast.